What if the biggest financial crisis of your lifetime didn't start with panic, but with calm? Every major financial collapse in history has something unsettling in common. Not chaos, not headlines, not riots or crashes. Silence. Before the system breaks, it almost always looks stable. Markets are calm, experts sound confident, governments reassure, and the public is told the same familiar line. Everything is under control. This video is not about fear, it's about patterns. Because if you study modern financial history closely, especially in the United States, you start to notice something disturbing. Crises done tea. Arrive suddenly. They arrive after long periods of engineered stability, and by the time instability becomes visible, the outcome is already locked in. The illusion of stability feels safe. It feels responsible. It feels like proof that the system works. But in financial systems, stability is often not strength. It's delay. Think about what stability really means in modern economies. Low volatility, predictable growth, controlled inflation, managed interest rates. On the surface, these look like achievements. Underneath, they often hide accumulated pressure. Just like a fault line that hasn't moved in decades, the longer it stays quiet, the more destructive the eventual release becomes. Financial systems work the same way. Why governments fear collapse? More than distortion, governments don't manage economies the way engineers manage machines. They manage them politically. A sudden collapse is visible. It ends careers. It destroys trust overnight. Slow distortion, on the other hand, is subtle. If wages fall slowly in real terms, people adapt. If prices rise gradually, people blame corporations. If debt expands quietly, few notice. From a political standpoint, delay is safer than correction. And that's why modern financial systems are built around postponement, not resolution. The American pattern in the US. This pattern repeats over and over. Excess builds up. Risk concentrates. Warning signals appear. Authorities respond by smoothing volatility. The system looks calmer than ever right before it breaks. This happened before the Great Depression, before the 1970s inflation crisis, before the dot-com bubble, before 2008, and each time the same logic guided decisions. Prevent panic today. Deal with consequences tomorrow. Why calm is often the final stage. Here, as the paradox most people miss, the most dangerous phase of a financial cycle is not the crash. It's the calm before it. Why? Because calm convinces people that risk is gone. Investors increase leverage. Consumers increase debt. Institutions take larger positions. Regulators loosen standards. The system doesn't just survive stability, it feeds on it. And the longer calm lasts, the more fragile everything underneath becomes. Debt, the silent accelerator. Stability and debt grow together. When markets are calm and interest rates are low, borrowing feels harmless, cheap, logical, even responsible. But debt doesn't disappear in stable periods. It accumulates. Households carry more. Corporations leverage more. Governments refinance instead of reducing. Nothing looks broken, but flexibility disappears. Eventually, the system reaches a point where it cannot tolerate instability anymore. Even a small shock becomes catastrophic. Why warnings? Our ignored financial warnings rarely fail because they're wrong. They fail because they're inconvenient. Warnings force decisions. Decisions create losers. Losers create backlash. So instead of addressing root problems, systems respond with surface-level calm, liquidity injections, emergency measures, policy adjustments framed as temporary. Temporary becomes permanent, and permanent becomes fragile. Stability as a narrative. Tool stability isn't just an economic condition. It's a story told to markets, to voters, to institutions. When leaders say the system is stable, what they often mean is the consequences haven't arrived yet. And most people don't realize this until after the fact. The cost of delay, every delayed correction increases the final cost. Small recessions become deep crises. Manageable inflation becomes persistent erosion. Local failures become systemic threats. Stability doesn't eliminate risk. It repackages it for later. And later is almost always worse. The question no one asks, so the real question isn't, will another crisis happen? The question is, how long can stability be maintained before it breaks? Because once stability becomes the goal instead of resilience, collapse stops being an accident. Problems are no longer solved, they are managed. Deficits are rolled forward. Debt is refinanced. Losses are hidden inside balance sheets, regulations, and accounting language most people never read. Nothing collapses. Nothing improves either. This is how temporary measures quietly become permanent architecture. The quiet trade-off. No one voted for Herr Crises. Here's the uncomfortable truth. Stability is often purchased by transferring cost from the present to the future, and that future is usually the public. Inflation quietly reduces purchasing power. Asset prices rise faster than wages. Savings lose value without an official tax. No law is passed. No vote is taken. Yet wealth shifts anyway. This is why financial systems prefer slow erosion over sudden collapse. Erosion doesn't provoke resistance. Why markets appear rational right? Until they don't, markets are not irrational. They are conditional. As long as participants believe support will arrive, risk looks manageable. That belief becomes self-reinforcing. Investors expect intervention. Institutions assume protection. The governments promise stability. Markets price and rescue. This is not confidence, it's dependency. And dependency creates fragility. The moment belief cracks, even slightly, the reaction is violent. Not because the problem appeared suddenly, but because it was ignored for too long. The pattern of recognition. Every crisis follows the same recognition curve. First, denial, then dismissal, then delayed acknowledgement, finally, emergency response. By the time the response arrives, the damage is already structural. Liquidity can stabilize prices. It cannot restore trust. And once trust is gone, systems don't fail gradually. They snap. Why ordinary people always feel betrayed. After every crisis, the same sentence appears, "No one could have seen this coming." That sentence is never true. Warnings always exist. Signals always appear. But they are drowned out by reassurance, authority, and comfort. People don't feel betrayed because systems collapse. They feel betrayed because they were told collapse was impossible. Stability versus resilience. Here's the distinction that changes everything. Stability resists movement. Resilience absorbs it. Stable systems look strong until they aren't. Resilient systems look messy, but survive shocks. Modern financial systems prioritize appearance over adaptability. Smooth charts, controlled narratives, predictable messaging. But resilience requires discomfort. It requires admitting weakness early, accepting volatility, allowing corrections before pressure becomes catastrophic. That rarely happens. The cost of pretending. Everything is fine. When stability becomes the goal, truth becomes dangerous. Truth forces adjustment. Adjustment creates friction. Friction threatens stability. So truth is delayed, softened, or reframed until it can't be anymore. At that point, the system doesn't correct. It overcorrects, and the public pays the price. Why this matters? Now this isn't history. It's a cycle, and cycles don't announce themselves. They repeat quietly, using familiar language and familiar promises. Understanding the pattern doesn't make you fearful. It makes you prepared. Prepared to question reassurance. Prepared to recognize calm as a signal, not a guarantee. Prepared to think independently when narratives feel too comfortable. The real advantage is awareness. Most people lose during financial transitions, not because they lack intelligence, but because they trust stability too much. They assume calm equals safety. They assume silence equals health. They assume delay equals control. History shows otherwise. Final thought. Every financial system eventually faces a choice: correct early and visibly, or delay quietly and pay later. When delay wins, collapse stops being a surprise. It becomes the final stage. If you want to understand how money, power, and financial systems actually work, not the comforting version, but the real one, subscribe. This channel doesn't chase panic. It studies patterns. Because once you see the pattern, you stop being surprised by the outcome.